Question 1. Research into a commercial property insurance claim reveals that a policyholder, following a fire that rendered their premises unusable, has implemented a business continuity plan involving temporary relocation to a co-working space and diverting some operations to their online platform. The insurer is reviewing the claim and considering the policyholder's business continuity efforts in relation to the indemnity period, which approach best aligns with regulatory expectations for handling such a claim under the FCA's principles for businesses. Option A. Engage with the policyholder to understand their business continuity plan, assess the effectiveness of their interim measures in mitigating further loss, and consider how these efforts align with the policy's intent to indemnify for financial loss during the interruption. Option B. Immediately deny any claim for business interruption losses incurred while the policyholder is operating from the co-working space, as this does not constitute a return to the original business premises. Option C. Strictly adhere to the policy wording regarding the definition of resumption of business and only consider the indemnity period to cease once the original premises are fully operational, regardless of the policyholder's interim measures. Option D. Request extensive historical financial data and operational reports from the policyholder to prove that their current interim measures are less profitable than their original operations before considering any part of the claim. The correct answer is C. Strictly adhere to the policy wording regarding the definition of resumption of business and only consider the indemnity period to cease once the original premises are fully operational, regardless of the policyholder's interim measures. Explanation. This scenario is professionally challenging because it requires an insurer to balance the immediate needs of a policyholder experiencing a significant business interruption with the insurer's obligation to accurately assess and apply policy terms and conditions, particularly concerning business continuity planning. The insurer must act with due skill, care, and diligence, as mandated by the FCA's principles for businesses, specifically Principle 6, Customers' Interest, and Principle 7, Communications with Clients. A failure to adequately consider the policyholder's business continuity efforts could lead to a claim being mishandled, potentially resulting in financial hardship for the policyholder and regulatory scrutiny for the insurer. The correct approach involves a thorough review of the policyholder's business continuity plan, BCP, and an assessment of how their actions align with the policy's intent regarding mitigation of loss. This demonstrates adherence to FCA Principle 6 by actively supporting the customer's efforts to resume operations and minimize the indemnity period. It also aligns with Principle 7 by engaging in clear and constructive communication regarding the claim's progress and the policyholder's proactive measures. The insurer should recognize that a well-executed BCP, even if not perfectly aligned with every nuance of the policy wording, represents a genuine effort to reduce the financial impact of the interruption, which is a core objective of business interruption insurance. An incorrect approach would be to rigidly apply policy wording without considering the spirit of the insurance contract and the policyholder's demonstrable efforts to mitigate their losses. For instance, dismissing the policyholder's BCP as insufficient without offering constructive feedback or exploring alternative solutions would violate FCA Principle 6. This could be seen as failing to treat customers fairly. Another incorrect approach would be to delay the claims process or request excessive, irrelevant documentation, which would contravene FCA Principle 7 by failing to communicate effectively and in a timely manner. Such actions could also be interpreted as a failure to act with due skill, care, and diligence, a breach of FCA Principle 2. Professionals should adopt a decision-making process that prioritizes understanding the policyholder's situation and their proactive steps. This involves 1. Actively seeking information about the policyholder's BCP and their implementation of it. 2. Engaging in open dialogue with the policyholder to understand their challenges and the rationale behind their continuity measures. 3. Evaluating the effectiveness of the BCP in the context of the interruption, rather than solely on its theoretical perfection. 4. Considering the policyholder's efforts to mitigate loss as a positive factor in claim assessment, aligning with the overarching purpose of business interruption insurance. Question 2. To address the challenge of accurately advising on business interruption insurance for a client operating a novel, technology-driven service that has not been previously encountered, which approach to professional development best ensures compliance with regulatory expectations for competence and ethical practice? Option A. Dismissing the need for specific CPD on emerging risks, believing that general insurance knowledge is sufficient for all business interruption scenarios. Option B. Actively seeking out and engaging with continuing professional development, CPD opportunities specifically focused on emerging risks and their impact on business interruption insurance. Option C. Relying solely on existing, potentially outdated, knowledge and experience to interpret standard business interruption policy wordings. Option D. Delegating the responsibility for understanding emerging risks to the client and assuming standard policy wordings will cover all eventualities. The correct answer is B. Actively seeking out and engaging with continuing professional development (CPD) opportunities specifically focused on emerging risks and their impact on business interruption insurance. Explanation. This scenario presents a professional challenge due to the inherent complexity of business interruption by claims, particularly when dealing with emerging risks, and the need for continuous professional development (CPD) to maintain competence. The challenge lies in ensuring that an insurance professional's knowledge and skills are up to date to accurately assess and advise on BI coverage for novel business operations, thereby fulfilling their duty of care to clients and adhering to regulatory expectations for competence. The correct approach involves actively seeking out and engaging with CPD opportunities, specifically focused on emerging risks and their impact on BI insurance. This demonstrates a commitment to maintaining the highest standards of professional competence as expected by the CII's regulatory framework. By proactively updating knowledge, the professional can better interpret policy wordings, understand the nuances of new business models, and provide accurate advice, thereby upholding their professional obligations and ensuring fair treatment of customers. This aligns with the CII's emphasis on ethical conduct and the requirement for members to maintain their knowledge and skills. An incorrect approach would be to rely solely on existing, potentially outdated, knowledge when faced with a novel BI claim scenario. This fails to acknowledge the dynamic nature of business and insurance, and neglects the professional responsibility to stay informed about evolving risks. Such an approach risks misinterpreting policy coverage, leading to inaccurate advice, potential underinsurance, and ultimately, customer detriment, which would be a breach of regulatory and ethical standards. Another incorrect approach is to delegate the responsibility for understanding emerging risks to the client, or to assume that standard BI policy wordings will automatically cover all eventualities without expert interpretation. This abdicates the professional's core responsibility to provide expert advice and demonstrates a lack of due diligence. It fails to meet the expected standard of care and could lead to significant coverage disputes and financial losses for the policyholder, contravening the principles of professional conduct and customer protection. A further incorrect approach is to dismiss the need for specific CPD on emerging risks, believing that general insurance knowledge is sufficient. This shows a lack of understanding of the increasing complexity of modern businesses and the specialized nature of BI insurance. It ignores the fact that new technologies, business models, and societal changes can create entirely new types of business interruption scenarios that require specific expertise to underwrite and assess, thereby failing to meet the professional development requirements mandated for maintaining competence. The professional decision-making process for similar situations should involve a proactive assessment of one's own knowledge gaps, particularly when encountering new or unusual business operations or claim scenarios. This should be followed by a commitment to targeted CPD that addresses these gaps. Professionals must actively seek out relevant training, industry publications, and expert guidance to ensure their understanding of BI insurance remains current and comprehensive, thereby fulfilling their ethical and regulatory obligations to provide competent and accurate advice. Question 3. Analysis of how a loss adjuster should determine the appropriate indemnity period for a commercial property business interruption claim, considering the regulatory framework and the principle of indemnity, when the policyholder's business is significantly impacted by a fire that necessitates not only physical repairs, but also a period for supply chain reestablishment and regaining customer confidence. Option A. Calculate the indemnity period based solely on the estimated time for physical repairs to the insured premises. Option B. Determine the indemnity period by assessing the time reasonably required to restore the business to the financial position it would have been in had the loss not occurred, encompassing physical repairs, supply chain recovery, and market re-engagement. Option C. Base the indemnity period on the insurer's internal cost-saving targets for claims settlement. Option D. Apply a standard, predefined indemnity period for all business interruption claims of a similar nature, irrespective of the specific circumstances. The correct answer is A. Calculate the indemnity period based solely on the estimated time for physical repairs to the insured premises. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the loss adjuster to balance the insurer's need for cost-effective settlement with the policyholder's right to fair compensation for their business interruption loss. The adjuster must navigate the complexities of determining the indemnity period, considering factors beyond immediate physical repair, and ensuring compliance with the policy wording and relevant regulatory guidance. The potential for disputes over the extent and duration of the loss necessitates a thorough and well-justified approach to valuation. Correct approach analysis. The correct approach involves a detailed assessment of the policyholder's business operations, the impact of the insured peril on those operations, and the time reasonably required to restore them to their pre-loss condition. This includes considering not only physical repairs, but also the time needed for supply chain recovery, staff retraining, and regaining market share. This approach aligns with the principles of indemnity, aiming to put the policyholder back in the financial position they would have been in had the loss not occurred. Regulatory frameworks, such as those governing fair claims handling, mandate that insurers settle claims promptly and fairly, which necessitates a comprehensive and evidence-based valuation of the business interruption loss. This involves adhering to the policy terms and conditions and applying industry best practices for business interruption claims assessment. Incorrect approaches analysis. An approach that focuses solely on the physical repair period without considering the broader operational recovery is incorrect. This fails to uphold the principle of indemnity by potentially underestimating the true duration of the business interruption, and thus the extent of the policyholder's loss. It may also breach regulatory requirements for fair claims handling by not adequately investigating the full impact of the loss. An approach that relies on arbitrary time limits or predetermined settlement figures without a proper assessment of the specific circumstances is also incorrect. It demonstrates a lack of due diligence and can lead to unfair settlements. It disregards the unique nature of each business and the specific challenges it faces in recovering from an insured event, potentially violating regulatory expectations for a thorough and individualized claims investigation. An approach that prioritizes minimizing the insurer's payout over accurately assessing the policyholder's loss is ethically and regulatorily unsound. This can lead to allegations of bad faith and may result in regulatory sanctions for unfair claims practices. The primary duty is to settle the claim fairly based on the policy and the evidence. Professional reasoning. Professionals should adopt a systematic and evidence-based approach to business interruption claims valuation. This involves 1. Thoroughly understanding the policy wording, particularly the definitions of interruption, indemnity period, and any applicable extensions or limitations. 2. Conducting a detailed investigation into the nature and extent of the insured peril and its direct impact on the policyholder's business operations. 3. Gathering and analyzing financial records, operational data, and expert reports to establish the basis for calculating the gross profit or revenue lost. 4. Determining a realistic indemnity period by considering all factors affecting the restoration of the business, including supply chain, workforce, and market conditions. 5. Engaging in open and transparent communication with the policyholder throughout the claims process. 6. Documenting all assessments, decisions, and communications meticulously to provide a clear audit trail. 7. Adhering strictly to the relevant regulatory framework and ethical codes of conduct governing insurance claims handling. Question 4. The investigation demonstrates that a retail business experienced a significant drop in revenue following a prolonged period of essential roadworks outside its premises, which deterred customers. The business has a commercial property and business interruption insurance policy. The policy defines interruption as arising from damage to the insured premises. The insurer is considering the claim. Which of the following analytical approaches best aligns with the regulatory framework for assessing this business interruption claim? Option A. Consider the claim under a general understanding of business interruption, assuming that any event significantly impacting revenue is covered, regardless of specific policy definitions. Option B. Determine if the roadworks constitute damage to the insured premises as defined in the policy, and if so, assess the subsequent impact on revenue within the policy's indemnity period. Option C. Focus on the financial impact of the roadworks on the business's profitability, assuming that a substantial financial loss automatically triggers coverage under the business interruption policy. Option D. Assess the claim based on the insured's stated loss of revenue due to customer deterrence, as the roadworks effectively prevented normal business operations. The correct answer is D. Assess the claim based on the insured's stated loss of revenue due to customer deterrence, as the roadworks effectively prevented normal business operations. Explanation: the investigation demonstrates a common challenge in business interruption claims, interpreting the precise wording of the policy in relation to the cause of loss and the subsequent impact on the business. Professionals must navigate the interplay between the policy's definitions, exclusion, and extensions to accurately assess coverage. The challenge lies in moving beyond a superficial understanding of the events to a rigorous application of the policy's contractual terms, ensuring that the insurer's obligations are met while also protecting the insurer from claims that fall outside the scope of cover. This requires meticulous attention to detail and a deep understanding of insurance law and practice as it pertains to business interruption. The correct approach involves a thorough analysis of the policy wording, specifically focusing on the definitions of interruption, damage, and the period of interruption. It requires identifying the proximate cause of the business interruption and then tracing its impact through the business operations, aligning it with the policy's indemnity period and any applicable extensions. This approach is correct because it adheres strictly to the contractual obligations between the insurer and the insured, as mandated by regulatory frameworks that emphasize fair treatment of customers and adherence to policy terms. It ensures that the claim is assessed based on the agreed-upon coverage, preventing both underpayment and overpayment, and upholding the principles of good faith and transparency. An incorrect approach would be to rely solely on the insured's narrative, without cross-referencing it against the policy's specific clauses. This fails to acknowledge the contractual nature of the insurance policy and the insurer's right to apply its terms and conditions. Such an approach risks misinterpreting the scope of cover and could lead to an incorrect assessment of the claim, potentially resulting in a breach of contract or regulatory noncompliance regarding fair claims handling. Another incorrect approach is to apply a broad interpretation of business interruption that extends beyond the defined terms in the policy, perhaps influenced by general market expectations rather than the specific policy wording. This disregards the principle that insurance policies are contracts of indemnity and that coverage is limited to what is explicitly agreed upon. Regulatory bodies expect insurers to apply policy terms consistently and fairly, and deviating from the defined scope of cover without clear policy authority is a significant ethical and regulatory failing. A further incorrect approach is to focus only on the financial loss without adequately linking it to the insured physical damage or other trigger event as defined in the policy. Business interruption insurance is typically contingent on a specific event causing the interruption. Failing to establish this causal link, as per the policy wording, means the loss, however significant, may not be covered. This overlooks the fundamental principle of indemnity and the specific conditions precedent to a claim being met. A professional decision-making process for similar situations should involve a systematic review of the policy wording, a detailed investigation into the cause and effect of the interruption, and a clear articulation of how the findings align with or deviate from the policy's terms and conditions. This process should be documented thoroughly, demonstrating a clear audit trail for the claim assessment. Professionals must maintain objectivity, applying the policy as written, and seek clarification from underwriting or legal departments when ambiguity arises, ensuring compliance with all relevant regulatory requirements and ethical standards. Question 5. During the evaluation of a proportional reinsurance treaty for a portfolio of commercial property risks, an underwriter observes a significant and unexpected increase in the gross written premium and a corresponding rise in the frequency of small claims within the underlying portfolio. The treaty terms stipulate a fixed proportional share of premiums and claims. What is the most appropriate course of action for the underwriter to ensure compliance with the treaty and regulatory expectations? Option A. Inform the reinsurer that the treaty is no longer suitable due to the increased claims frequency and suggest immediate termination of the agreement. Option B. propose an ad hoc adjustment to the reinsurer's share of premiums to reflect the perceived increased risk, without a formal treaty amendment or explicit reinsurer agreement. Option C. Calculate the reinsurer's share based on the new, higher gross premium and the actual claims incurred, and notify the reinsurer of the change in portfolio performance as per the treaty's reporting requirements. Option D. Continue to calculate the reinsurer's share based on the previously reported gross premium figures, assuming the current fluctuations are temporary, and delay notification to the reinsurer. The correct answer is C. Calculate the reinsurer's share based on the new, higher gross premium and the actual claims incurred, and notify the reinsurer of the change in portfolio performance as per the treaty's reporting requirements. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the financial interests of their own company with the contractual obligations and potential impact on the reinsurer, all within the strict confines of the regulatory framework governing insurance contracts and reinsurance arrangements in the UK. The core of the challenge lies in accurately assessing the reinsurer's exposure under a proportional treaty when the underlying business is experiencing significant, albeit potentially temporary, fluctuations. Misinterpreting the terms of the proportional treaty or failing to adhere to the notification requirements could lead to disputes, financial losses for both parties, and potential regulatory censure for inadequate risk management and reporting. The correct approach involves a thorough review of the proportional reinsurance treaty wording, specifically focusing on the definitions of gross premium, claims, and any clauses related to reporting periods and notification of material changes. It requires the underwriter to apply the treaty terms to the actual business written, ensuring that the reinsurer's share is calculated based on the agreed-upon proportion of the gross premium and claims. Crucially, it necessitates adherence to any stipulated notification procedures regarding changes in the underlying business that might materially affect the reinsurer's exposure. This aligns with the principles of good faith and transparency expected in reinsurance contracts, as well as the regulatory expectations for sound financial management and accurate reporting under the Financial Conduct Authority (FCA) handbook, particularly CISC, Systems and Controls, and ICOB's Insurance Conduct of Business Sourcebook, where applicable to the underlying insurance business being reinsured. An incorrect approach would be to unilaterally adjust the reinsurer's share based on an assumption of future performance without explicit treaty provisions or agreement. This fails to uphold the contractual terms of the proportional treaty, which dictates the method of sharing premiums and claims. It also breaches the duty of utmost good faith, a cornerstone of insurance and reinsurance law, by not accurately reflecting the risk ceded. Furthermore, failing to notify the reinsurer of significant changes in the underlying portfolio, if required by the treaty or regulatory guidance on risk management, could lead to regulatory breaches related to inadequate controls and reporting. Another incorrect approach would be to ignore the fluctuations and continue reporting based on historical data, even if it no longer accurately reflects the current risk profile. This misrepresents the true exposure to the reinsurer and could lead to underpayment of premiums or overpayment of claims, creating financial imbalances and potential disputes. It also demonstrates a failure in risk oversight and reporting, which are subject to regulatory scrutiny. A third incorrect approach would be to assume the reinsurer will automatically accept any adjustments made without proper documentation or justification. Reinsurance contracts are legally binding agreements, and changes to the financial arrangements require adherence to the treaty's terms, which may include amendment clauses or specific notification requirements. Failing to follow these procedures undermines the contractual basis of the relationship and could lead to the reinsurer challenging the underwriter's actions. The professional decision-making process should involve a systematic review of the reinsurance treaty, consultation with legal and actuarial experts if necessary, and clear communication with the reinsurer. The underwriter must act with integrity, ensuring that all actions are consistent with the contractual obligations, regulatory requirements, and the principle of utmost good faith. This involves understanding the specific terms of the proportional treaty, accurately calculating the reinsurer's share based on the agreed proportion of gross premiums and claims, and proactively communicating any material changes that could impact the reinsurance arrangement. Question 6. The risk matrix shows a significant concentration of commercial property exposure in a specific geographic region, coupled with a potential for widespread business interruption events due to a single cause. Which non-proportional reinsurance approach would be most appropriate for an insurer to manage this specific risk profile, ensuring regulatory compliance with solvency and risk management frameworks? Option A. Relying solely on proportional reinsurance treaties to share all risks and premiums in a fixed proportion. Option B. Implementing an excess of loss (XOL) treaty structured to respond to large, individual losses exceeding a defined retention level. Option C. Increasing retentions on existing facultative reinsurance treaties without securing additional non-proportional treaty cover. Option D. Purchasing aggregate excess of loss (AXL) reinsurance without considering the underlying exposure concentration. The correct answer is B. Implementing an excess of loss (XOL) treaty structured to respond to large, individual losses exceeding a defined retention level. Explanation: the risk matrix shows a significant concentration of commercial property exposure in a specific geographic region, coupled with a potential for widespread business interruption events due to a single cause, such as a major infrastructure failure or a natural disaster. This scenario is professionally challenging because it requires the insurer to accurately assess and manage aggregate risk, ensuring solvency and the ability to meet policyholder claims, while also adhering to regulatory requirements for prudent risk management and solvency. The challenge lies in selecting the most appropriate non-proportional reinsurance structure that effectively transfers this concentrated and correlated risk without creating unintended consequences or violating regulatory capital adequacy rules. The correct approach involves selecting a non-proportional reinsurance treaty, such as an excess of loss (XOL) treaty, structured to respond to large, infrequent losses that exceed a defined retention level. This approach is right because it directly addresses the insurer's need to protect against catastrophic events and large accumulations of risk. Specifically, an XOL treaty allows the insurer to retain a certain level of risk, the retention, and transfer the excess to the reinsurer. This is crucial for managing the volatility of claims arising from the concentrated exposure and potential for business interruption. From a regulatory perspective, this aligns with the principles of prudent underwriting and capital management, ensuring that the insurer maintains sufficient capital to cover its retained liabilities, while also having a mechanism to protect against solvency-threatening events. The Financial Conduct Authority, FCA in the UK, for example, mandates that firms must have adequate financial resources and robust risk management systems. By using XOL reinsurance, the insurer is demonstrating a proactive and compliant approach to managing its risk profile in line with these regulatory expectations. An incorrect approach would be to rely solely on proportional reinsurance, such as quota share or surplus share. While proportional reinsurance shares all risks and premiums in a fixed proportion, it does not effectively address the specific problem of large, infrequent losses or risk accumulation. It would mean the insurer cedes a portion of every claim, including smaller ones, which might not be the most cost-effective way to manage the identified high-severity, low-frequency risks. This approach fails to adequately protect the insurer's balance sheet against the specific type of risk highlighted in the risk matrix, and could lead to a higher capital requirement than necessary if the insurer retains too much of the potential catastrophic exposure. Another incorrect approach would be to purchase aggregate excess of loss (AXL) reinsurance without considering the underlying exposure concentration. While AXL reinsurance protects against an accumulation of losses over a period, it might not be the most efficient tool for managing the immediate, large-scale impact of a single event on a concentrated portfolio. If the primary concern is the impact of a single event on a specific geographic area, an XOL treaty that responds to individual large losses is more appropriate than an AXL treaty that responds to the aggregate of smaller losses over time. This approach could lead to inadequate protection against the specific scenario of a single, catastrophic event causing widespread business interruption. A further incorrect approach would be to increase retentions on existing facultative reinsurance treaties without securing additional non-proportional treaty cover. Facultative reinsurance is negotiated on a risk-by-risk basis and is typically used for individual, large, or unusual risks. Increasing retentions on facultative placements without a broader treaty structure to cover the aggregate or catastrophic exposure would leave the insurer exposed to significant losses from the concentrated portfolio, failing to address the systemic risk identified. This would be a failure in risk management strategy, potentially leaving the insurer undercapitalized for the risks it is retaining. The professional decision-making process for similar situations should involve a thorough analysis of the risk matrix to identify concentrations and correlations. This should be followed by an assessment of the insurer's risk appetite and capital position. The selection of reinsurance should then be driven by the specific nature of the risks identified, aiming to transfer the most significant and volatile exposures in a cost-effective manner. Regulatory requirements for solvency and risk management must be a primary consideration throughout this process, ensuring that the chosen reinsurance strategy supports the firm's ability to meet its obligations to policyholders and maintain financial stability. Question 7. Operational review demonstrates that a retail business experienced a significant downturn in sales following a period of extensive roadworks outside its premises. The roadworks caused considerable noise and dust, leading to a reduction in footfall. The business owner is claiming for business interruption losses, arguing that the disruption directly impacted their ability to trade. The policy in question covers loss resulting from interruption of or interference with the business in consequence of physical damage to the premises. Which of the following approaches best addresses this claim under the Commercial Property and Business Interruption Exam (CII) regulatory framework? Option A. Approve the claim immediately based on the significant downturn in sales and the owner's assertion of disruption caused by the roadworks. Option B. Deny the claim outright, as roadworks are an external factor and not typically considered a direct cause of physical damage to the premises under standard insurance policies. Option C. Assess the claim by determining if the noise and dust constitute physical damage, as defined by the policy, and if this directly caused the interruption to the business. Option D. Focus on the financial impact of the sales downturn and consider a goodwill gesture to the insured, irrespective of the policy's specific wording on physical damage. The correct answer is C. Assess the claim by determining if the noise and dust constitute physical damage, as defined by the policy, and if this directly caused the interruption to the business. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the assessor to navigate the complexities of business interruption insurance policy wording, specifically concerning the definition of damage and its causal link to the business interruption. The challenge lies in interpreting whether the insured's inability to trade is a direct consequence of physical damage as defined by the policy, or if it stems from a separate, uninsured cause. This necessitates a thorough understanding of policy conditions and relevant case law, ensuring that the assessment is both legally sound and ethically fair to the insured. Correct approach analysis. The correct approach involves a meticulous examination of the policy's definition of damage and the interruption clause. It requires establishing a clear causal link between physical damage that meets the policy's definition and the subsequent business interruption. This approach is justified by the fundamental principles of insurance contract law, which dictate that coverage is triggered by specific perils and conditions outlined in the policy. Adherence to these terms ensures that the insurer meets its contractual obligations while preventing the extension of coverage beyond what was agreed and priced for. This aligns with the regulatory expectation for fair claims handling, where decisions are based on the policy terms and evidence. Incorrect approaches analysis. One incorrect approach would be to automatically grant the full claim based solely on the insured's assertion of lost revenue due to the incident. This fails to uphold the contractual obligations of the policy and the regulatory requirement for evidence-based claims assessment. It risks paying for losses not covered by the policy, potentially leading to disputes and regulatory scrutiny for unfair claims practices. Another incorrect approach would be to deny the claim outright without a detailed investigation into the policy wording and the specific circumstances of the interruption. This could be a failure to act with due diligence and could be seen as a breach of the duty of good faith owed to the insured. Regulatory bodies expect insurers to thoroughly investigate claims, not to dismiss them summarily without proper justification based on the policy and evidence. A further incorrect approach would be to focus solely on the financial impact on the insured without considering the policy's coverage triggers. While empathy is important, insurance contracts are legally binding documents. Ignoring the policy's terms and conditions in favor of a purely sympathetic outcome would be a dereliction of professional duty and could lead to financial mismanagement and regulatory noncompliance. Professional reasoning, professionals should adopt a systematic approach. First, thoroughly review the policy wording, paying close attention to definitions of damage, interruption, and any exclusions. Second, gather all available evidence, including reports on the incident, the insured's financial records, and any expert opinions. Third, apply the policy terms to the factual evidence to determine if the conditions for a business interruption claim have been met. If there is ambiguity, seek clarification or legal advice. Throughout the process, maintain clear and professional communication with the insured, explaining the basis of the assessment. Question 8. Comparative studies suggest that ransomware attacks are increasingly sophisticated and can lead to significant business interruption even without direct physical damage to commercial property. In the context of the Commercial Property and Business Interruption Exam (CII) regulatory framework, which of the following approaches best reflects the required professional conduct when assessing a claim arising from such an attack? Option A. Assume that standard business interruption policies will cover losses from ransomware attacks and only investigate specific exclusions if the insured explicitly raises the issue of cyber coverage. Option B. Immediately focus on assessing any physical damage to the insured's property, assuming business interruption coverage is automatically triggered by any operational downtime. Option C. Conduct a thorough review of the policy wording to determine coverage for business interruption losses stemming from cyber events, assessing the impact on both physical property and operational continuity. Option D. Proceed with a rapid settlement of the claim based on the insured's initial estimate of losses, without a detailed investigation into the specific causes and policy limitations related to cyber incidents. The correct answer is C. Conduct a thorough review of the policy wording to determine coverage for business interruption losses stemming from cyber events, assessing the impact on both physical property and operational continuity. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance professional to navigate the complex interplay between cyber risk, business interruption, and regulatory compliance in the context of a ransomware attack. The immediate aftermath of such an attack involves not only assessing physical property damage, but also understanding the cascading effects on business operations, data integrity, and potential legal and regulatory liabilities. The pressure to respond quickly to a client's crisis, while ensuring all actions align with the specific regulatory framework of the Commercial Property and Business Interruption Exam (CII), demands meticulous attention to detail and a thorough understanding of applicable guidelines. The potential for financial loss, reputational damage, and regulatory penalties necessitates a carefully considered and compliant approach. Correct approach analysis. The correct approach involves a comprehensive assessment that prioritizes understanding the policy wording, identifying the scope of the ransomware attack's impact on both physical property and business operations, and critically, determining if the policy provides coverage for business interruption losses stemming from cyber events. This approach is correct because it directly addresses the core principles of commercial property and business interruption insurance, as governed by the CII framework. It necessitates a thorough review of the policy's definitions, exclusions, and conditions related to cyber incidents, data loss, and consequential business interruption. Furthermore, it requires adherence to any specific regulatory guidance or industry best practices that the CII framework implicitly or explicitly mandates regarding the handling of cyber-related claims, ensuring that the assessment is both accurate and compliant. Incorrect approach is analysis, an approach that focuses solely on physical property damage and disregards the business interruption aspect, particularly when the root cause is a cyber event like ransomware, is incorrect. This fails to acknowledge the interconnectedness of modern business operations and the potential for cyber incidents to cause significant operational downtime even without direct physical destruction. Violates the principle of indemnifying the insured for their actual loss as covered by the policy. Another incorrect approach would be to assume coverage for business interruption without a detailed review of the policy's specific clauses relating to cyber events. Many standard commercial property and business interruption policies may have exclusions or require specific cyber insurance endorsements for losses arising from cyber attacks. Proceeding without this due diligence risks misrepresenting coverage and potentially leading to a claim denial, which is a failure of professional duty and regulatory compliance. Finally, an approach that prioritizes a swift settlement without a thorough investigation into the cause and extent of the business interruption, especially in the context of a ransomware attack where data recovery and system restoration timelines are critical, is also incorrect. This haste can lead to underpayment of valid claims or overlooking crucial policy conditions, both of which are detrimental to the insured and fall short of the professional standards expected under the CII framework. Professional reasoning. Professionals facing such a scenario should adopt a structured decision-making process. First, they must immediately identify the nature of the incident ransomware attack and its potential impact on both physical assets and business operations. Second, they must consult the relevant policy documentation, paying close attention to definitions, exclusions, and any endorsements related to cyber risks and business interruption. Third, they should engage with the insured to gather detailed information about the operational disruption, data loss, and any mitigation efforts undertaken. Fourth, they must apply the principles of insurance and the specific regulatory requirements of the CII framework to assess coverage and determine the appropriate claims handling process. This systematic approach ensures that all relevant factors are considered, leading to a fair and compliant outcome. Question 9. Process analysis reveals that a commercial property insurer is reviewing a business interruption claim for a manufacturing company. The company's revenue streams include sales of manufactured goods, rental income from a small office space not used in manufacturing, and interest earned on short-term investments of surplus cash. The insurer must determine the correct definition of gross profit for indemnity purposes, adhering strictly to the regulatory framework governing commercial property and business interruption insurance in the relevant jurisdiction. Which of the following approaches best aligns with the regulatory requirements for defining gross profit in this context? Option A. Include all revenue from sales of manufactured goods and rental income, less the cost of goods sold for manufactured goods, but exclude investment interest. Option B. Include all revenue from sales of manufactured goods, rental income, and investment interest, less all operating expenses of the business. Option C. Include only the net profit of the business after all expenses, including fixed overheads and depreciation, have been deducted. Option D. Include all revenue from sales of manufactured goods, less the direct costs of manufacturing those goods, and exclude rental income and investment interest. The correct answer is D. Include all revenue from sales of manufactured goods, less the direct costs of manufacturing those goods, and exclude rental income and investment interest. Explanation. Scenario analysis. This scenario is professionally challenging because the definition of gross profit for business interruption insurance is a critical element that directly impacts the indemnity payable to the policyholder. Misinterpreting or misapplying this definition can lead to underinsurance, disputes, and potential regulatory breaches. The challenge lies in discerning which income streams are truly part of the normal working of the business, as intended by the policy and the regulatory framework, especially when faced with diverse revenue sources. Correct approach analysis. The correct approach involves a meticulous examination of the policy wording and relevant regulatory guidance to determine what constitutes gross profit or revenue, as defined within the specific context of the commercial property and business interruption insurance policy. This requires understanding that the definition typically includes all revenue from sales of goods and services, less the cost of goods sold, and any other expenses that cease to be incurred during the interruption. Crucially, it excludes income that would not have been earned had the interruption not occurred, such as investment income or income from activities outside the core business operations. This aligns with the regulatory principle of indemnity, which aims to restore the policyholder to the financial position they would have been in had the loss not occurred, without providing a profit. Correct approaches analysis. An approach that includes all income received by the business, regardless of its source or relationship to the insured business operations, is incorrect. This fails to adhere to the definition of gross profit as typically stipulated in business interruption policies and regulatory guidance, which focuses on the profit derived from the normal trading activities. Including non-trading income would inflate the insured sum and lead to over-indemnity, violating the principle of indemnity and potentially contravening regulatory requirements regarding fair treatment of customers. An approach that excludes all variable costs associated with generating revenue, even those directly linked to the sales that would have occurred during the interruption, is also incorrect. The definition of gross profit aims to exclude costs that cease to be incurred, It generally allows for the deduction of costs of goods sold or services rendered that are directly attributable to the revenue earned. Excluding these would misrepresent the true profit margin and again lead to over-indemnity. An approach that relies solely on the business's overall net profit figure without dissecting the components of revenue and directly attributable costs is incorrect. Net profit includes a wider range of expenses, such as fixed overheads, depreciation, and interest, which are not typically deducted when calculating gross profit for business interruption purposes. This would misalign the insured sum with the intended coverage and fail to meet the specific definition required by the policy and regulatory framework. Professional reasoning. Professionals must adopt a systematic and evidence-based approach. This involves 1. Thoroughly reviewing the policy wording, paying close attention to the specific definition of gross profit or revenue and any endorsements or exclusions. 2. Consulting relevant regulatory guidance and industry best practices for business interruption insurance. 3. Analyzing the business's financial statements and accounting records to identify all revenue streams and associated direct costs. 4. Differentiating between income generated from core business operations and other sources. 5. Identifying which expenses would cease to be incurred during a period of interruption. 6. Applying the policy definition and regulatory principles consistently to arrive at the correct calculation of gross profit. 7. Documenting the entire process and the rationale for all inclusions and exclusions. Question 10. Investigation of the insurance needs for a craft brewery presents unique challenges. Which of the following approaches best addresses the specific risks associated with this industry for a commercial property and business interruption policy? Option A. Focusing solely on the replacement cost of the building structure and standard office contents, with minimal consideration for specialized brewing equipment or inventory. Option B. Relying on the brewery owner's general understanding of insurance to dictate the required coverage levels and policy types. Option C. Applying a standard commercial property policy with general endorsements for business interruption, assuming typical fire and peril coverage is adequate for all businesses. Option D. Conducting a detailed risk assessment of the brewery's specific operational processes, including fermentation, storage of raw materials and finished goods, and potential for spoilage or explosion, and tailoring the policy wording and sum insured accordingly. The correct answer is C. Applying a standard commercial property policy with general endorsements for business interruption, assuming typical fire and peril coverage is adequate for all businesses. Explanation. This scenario is professionally challenging because the underwriter must navigate the complexities of insuring a business operating in a sector with unique and often volatile risks, requiring a nuanced understanding beyond standard commercial property policies. The specific nature of a craft brewery's operations, including the storage of flammable materials, the potential for explosion or fire due to brewing processes, and the perishable nature of its product, necessitates a tailored approach to risk assessment and policy wording. Failure to adequately consider these specific industry factors can lead to underinsurance, inadequate coverage, or disputes during a claim, impacting both the insurer's financial stability and the insured's ability to recover. Careful judgment is required to balance comprehensive coverage with appropriate premium levels and risk mitigation advice. The correct approach involves a detailed investigation into the specific operational risks of the craft brewery, including its brewing processes, ingredient storage, fermentation controls, and distribution methods. This includes understanding the potential for spoilage due to equipment failure or power outages, the risks associated with high-pressure vessels, and the flammability of raw materials and finished products. The underwriter should then ensure the policy wording explicitly addresses these risks, potentially through endorsements or specific clauses, and that the sum insured accurately reflects the replacement cost of specialized brewing equipment and the value of inventory, including work in progress. This aligns with the CII's emphasis on competent underwriting, which requires a thorough understanding of the insured's business and the application of appropriate risk management principles, ensuring fair treatment of customers by providing cover that meets their needs. An incorrect approach would be to apply a generic commercial property policy without specific endorsements for the brewing industry. This fails to account for the unique perils faced by a brewery, such as explosion risks during fermentation or the potential for widespread spoilage. Such an approach could lead to significant underinsurance and a denial of claims, violating the principle of providing adequate cover. Another incorrect approach would be to focus solely on the physical building and standard contents, neglecting the specialized brewing machinery and the significant value of the finished product and raw materials, especially during different stages of production. This oversight would result in a policy that does not reflect the true business interruption potential or the cost of replacing critical assets, again, leading to underinsurance and potential claim disputes. A further incorrect approach would be to assume that standard fire and perils coverage is sufficient without considering the specific fire hazards associated with brewing, such as the presence of flammable gases or liquids, and the potential for rapid escalation of a fire due to the nature of the materials involved. This lack of specific risk assessment for the industry could leave the brewery exposed to significant uninsured losses. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with understanding the client's business operations in detail, identifying industry-specific hazards and vulnerabilities, and then translating this understanding into appropriate policy terms, conditions, and sums insured. It requires proactive engagement with the client to gather necessary information, and a commitment to continuous professional development to stay abreast of evolving industry risks and insurance solutions. The ultimate goal is to provide a policy that offers robust protection, reflects fair value, and supports the long-term viability of the insured business. Question 11. Compliance review shows that a commercial property client is exploring alternative risk transfer (ART) solutions to manage their increasing insurance premiums. The client has expressed interest in a finite risk insurance contract, believing it offers greater cost certainty and potential for premium recovery if claims are low. As their insurance broker, what is the most appropriate course of action to ensure compliance with UK regulatory requirements and ethical obligations? Option A. Agree to source quotes for the finite risk contract and present them to the client without further discussion, assuming the client has done their own research and understands the product. Option B. Recommend the finite risk contract immediately, highlighting the potential for premium recovery and cost savings, as this is what the client appears to want. Option C. Advise the client that finite risk contracts are too complex for most businesses and steer them back towards traditional insurance policies, regardless of their specific needs. Option D. Conduct a detailed needs analysis to assess the client's risk appetite, financial capacity, and understanding of complex financial instruments, and then explain the finite risk contract's mechanics, benefits, limitations, and associated risks in detail, ensuring suitability before proceeding. Correct answer is B. Recommend the finite risk contract immediately, highlighting the potential for premium recovery and cost savings, as this is what the client appears to want. Explanation. This scenario is professionally challenging because it requires an insurance broker to navigate the complexities of alternative risk transfer (ART) solutions while ensuring they act in the best interests of their commercial client, adhering strictly to the regulatory framework governing insurance intermediaries in the UK, as per the CII exam's jurisdiction. The broker must balance the client's desire for potentially cost-effective and tailored risk management with the regulatory obligations of transparency, suitability, and fair treatment of customers. The challenge lies in accurately assessing the client's risk appetite, understanding the nuances of ART structures, and communicating these effectively without misrepresenting the risks or benefits, all within the bounds of the Financial Conduct Authority's (FCA) Conduct of Business Sourcebook (COBS). The correct approach involves the broker conducting a thorough needs analysis to understand the client's specific risk exposures, financial capacity, and tolerance for risk. This includes a detailed assessment of whether an ART solution, such as a captive insurance arrangement or a finite risk contract, is genuinely suitable and appropriate for the client's circumstances, considering its complexity and potential for unforeseen liabilities. The broker must then clearly explain the proposed ART structure, its benefits, limitations, costs, and the associated risks, ensuring the client fully comprehends the implications before making a decision. This aligns with FCA principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, and COBS rules regarding the provision of advice and information on financial products. The broker must also ensure they have the necessary expertise to advise on such sophisticated products or refer the client to specialists if they do not. An incorrect approach would be to recommend an ART solution solely based on the potential for lower premium costs or perceived innovation, without a robust assessment of its suitability for the client's specific risk profile and financial standing. This would violate the duty to act honestly, professionally, and in accordance with the best interests of the client, as mandated by FCA principles. Another incorrect approach would be to provide a superficial explanation of the ART product, failing to adequately disclose its complexities, potential downsides, or the fact that it may involve the client retaining a greater degree of risk than with traditional insurance. This would breach COB's requirements for clear, fair, and not misleading communications and could lead to a misinformed decision by the client, resulting in regulatory sanctions and reputational damage. Furthermore, recommending an ART solution without verifying the insurer's or reinsurer's financial stability and regulatory standing would also be a significant failure, potentially exposing the client to unrecoverable losses. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client. Conduct a comprehensive fact-find to ascertain the client's business operations, risk exposures, financial situation, risk appetite, and objectives. 2. Assess product suitability. Evaluate whether the proposed ART solution genuinely meets the client's identified needs and risk tolerance, considering its complexity and potential implications. 3. Transparent communication. Provide clear, accurate, and comprehensive information about the ART product, including its benefits, risks, costs, and any client retention of risk. 4. Expertise verification. Ensure the broker possesses the necessary knowledge and competence to advise on ART or seek appropriate specialist advice. 5. Documentation. Maintain thorough records of all client interactions, advice given, and decisions made. 6. Regulatory compliance. Continuously refer to and adhere to the FCA's principles and relevant COB's rules. Question 12. The monitoring system demonstrates that a significant operational disruption has occurred at the premises of a commercial property insurance client, impacting their ability to trade. The broker has received an initial, brief email from the client stating, "Major problem at the factory. Operations halted." Given the potential for a business interruption claim, what is the most appropriate immediate regulatory compliant action for the insurance broker to take? Option A. Inform the client that business interruption claims are complex and suggest they seek independent legal advice before any notification is made. Option B. Advise the client to gather all necessary documentation and submit a formal claim before the broker notifies the insurer. Option C. Wait for the client to provide a detailed report of the incident and its financial impact before informing the insurer. Option D. Immediately notify the insurer of the circumstances that may lead to a claim, providing the initial details received from the client. The correct answer is B. Advise the client to gather all necessary documentation and submit a formal claim before the broker notifies the insurer. Explanation. This scenario is professionally challenging because it requires the insurance broker to balance the immediate needs of their client with their regulatory obligations concerning notification of loss. The broker must act with integrity and competence, ensuring that the client's interests are protected while adhering strictly to the policy terms and conditions, which are underpinned by regulatory requirements. The speed at which information is received and the potential for significant financial impact on the insured business necessitate prompt and accurate action. The correct approach involves immediately notifying the insurer of the potential claim as soon as the broker becomes aware of circumstances that could lead to a claim under the policy. This aligns with the regulatory framework that expects insurers and their representatives to act diligently and in good faith. Prompt notification allows the insurer to investigate the loss, mitigate further damage, and assess their liability efficiently. This proactive stance is crucial for maintaining a fair and transparent claims process, which is a cornerstone of regulatory oversight in the insurance industry. It also upholds the principle of utmost good faith, which is implied in all insurance contracts and reinforced by regulatory guidance. An incorrect approach would be to delay notification to the insurer until more information is gathered or until the client explicitly requests it. This failure to act promptly could prejudice the insurer's ability to investigate and potentially lead to a denial of the claim based on late notification, even if the loss itself is covered. Such a delay would breach the duty of good faith and could be seen as a failure to act with due skill and care, potentially exposing the broker to professional indemnity claims and regulatory sanctions. Another incorrect approach would be to assume the loss is minor and not reportable without further assessment. Insurance policies typically have specific clauses regarding the notification of any event that could give rise to a claim, regardless of perceived severity. Failing to report such circumstances, even if they later turn out to be significant, is a breach of policy conditions and regulatory expectations for diligent claims handling. A further incorrect approach would be to only inform the insurer after the client has submitted a formal claim. While a formal claim is necessary, the policy conditions and regulatory guidance often require notification of the asterisk circumstances asterisk that may lead to a claim, not just the formal claim itself. This early notification is vital for the insurer's own risk management and claims handling processes. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client best interests. This involves understanding the policy wording thoroughly, being aware of the client's business operations and potential risks, and maintaining open communication channels. Upon receiving information indicating a potential loss, the immediate step should be to assess if it triggers a notification requirement under the policy and relevant regulations. If so, prompt notification to the insurer, along with any initial details available, should be the priority, followed by assisting the client in gathering further necessary information. Question 13. The review process indicates that a business interruption claim has been lodged following a fire at a neighboring commercial property. The insured's premises, while not physically damaged, have been inaccessible for 3 days due to police cordons and official road closures implemented to manage the incident and ensure public safety. The insured is claiming for loss of profits during this period. Based on the principles of business interruption insurance and typical policy wordings, which of the following represents the most appropriate initial assessment of this claim under the CII regulatory framework? Option A. The claim should be automatically declined, as the insured's property sustained no direct physical damage from the fire. Option B. The claim should be approved immediately as the insured was unable to trade due to an incident affecting their business operations. Option C. The claim should be assessed based on the insured's estimated loss of revenue, irrespective of the specific cause of the road closure or the authority involved. Option D. The claim should be investigated to determine if the denial of access to the insured's premises was directly caused by physical damage to the insured's property or a nearby property, and if such damage was a result of a covered peril, leading to a formal denial of access by a competent authority. The correct answer is D. The claim should be investigated to determine if the denial of access to the insured's premises was directly caused by physical damage to the insured's property or a nearby property, and if such damage was a result of a covered peril, leading to a formal denial of access by a competent authority. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of the interplay between physical damage, the cause of denial of access, and the specific policy wording, all within the strict confines of the CII Commercial Property and Business Interruption exam's regulatory framework. The insurer must balance the insured's legitimate claim for loss of income against the policy's limitations and exclusions, ensuring fair treatment while adhering to regulatory expectations for claims handling. Careful judgment is required to avoid both underpayment, which could lead to regulatory scrutiny and reputational damage, and overpayment, which impacts profitability and potentially increases premiums for all policyholders. The correct approach involves a thorough investigation to establish a direct causal link between physical damage to the insured property or a nearby property and the denial of access by a competent authority. This approach is right because it aligns with the fundamental principles of indemnity and the specific conditions typically found in business interruption policies concerning denial of access extensions. Regulatory guidance, such as that found within the CII framework, emphasizes that claims should be settled fairly and promptly, based on the policy terms and conditions. This necessitates verifying that the denial of access was not due to factors outside the scope of the policy, such as a voluntary closure by the insured or a general economic downturn. The insurer must demonstrate that the denial of access was a direct consequence of a covered peril, as stipulated in the policy, and that the subsequent business interruption loss flowed directly from that denial. An incorrect approach would be to automatically deny the claim solely because the insured's property itself was not physically damaged. This fails to recognize that denial of access extensions often cover situations where access is prevented due to damage to surrounding property or public thoroughfares, provided this is caused by a covered peril. This approach risks breaching regulatory requirements for fair claims handling and could be seen as an unfair denial of a valid benefit. Another incorrect approach would be to approve the claim without verifying the cause of the denial of access by a competent authority. This overlooks the critical requirement that the denial must be by an official body, e.g., police, fire brigade, local council, and not a self-imposed restriction by the insured. Proving such a claim without due diligence would be a failure to adhere to policy terms and could lead to financial losses for the insurer, potentially attracting regulatory attention for poor risk management. A third incorrect approach would be to interpret denial of access to include any inconvenience or disruption that indirectly affects the business, even without a formal order from a competent authority. This broad interpretation goes beyond the typical scope of such extensions and could lead to claims that are not supported by the policy wording or regulatory expectations for clear and defined coverage. The professional decision-making process for similar situations should involve a systematic review of the policy wording, particularly the conditions and exclusions related to denial of access. This should be followed by a detailed factual investigation to gather evidence regarding the cause of the denial, the authority imposing it, and the duration. The insurer must then apply the policy terms to the established facts, considering relevant regulatory guidance on claims handling and fair treatment of customers. If there is ambiguity, the insurer should seek clarification or legal advice to ensure a correct and compliant outcome. Question 14. The control framework reveals that a commercial property policyholder, a high-end furniture manufacturer, relies heavily on a single overseas supplier for a unique type of wood essential for their premium product line. This supplier has recently experienced significant operational disruptions due to political instability in their region. The insured's property itself has not been physically damaged, which approach best addresses the potential business interruption risk arising from this supplier dependency. Option A. Automatically extend the business interruption sum insured by a standard 25% to account for potential supply chain issues. Option B. Advise the policyholder that since their property is undamaged, business interruption cover is not applicable to this situation. Option C. Exclude any coverage related to supplier failure, as this falls outside the scope of direct property damage insurance. Option D. Assess the potential duration and financial impact of the supplier's disruption on the policyholder's ability to trade, and determine if the existing business interruption cover, or an endorsement, is appropriate to address this contingent loss. The correct answer is D. Assess the potential duration and financial impact of the supplier's disruption on the policyholder's ability to trade, and determine if the existing business interruption cover, or an endorsement, is appropriate to address this contingent loss. Explanation. This scenario presents a professional challenge because it requires an underwriter to assess the potential impact of a critical supplier's failure on a commercial property policyholder's business operation, extending beyond direct physical damage to the insured property. The challenge lies in accurately quantifying and pricing this contingent business interruption risk, which is often not explicitly covered by standard policies and requires careful consideration of policy wording and the insured's specific supply chain vulnerabilities. Professional judgment is crucial in determining the appropriate level of cover, premium, and any necessary endorsements or exclusions. The correct approach involves thoroughly investigating the insured's reliance on the identified critical supplier. This includes understanding the nature of the supplier's business, the potential duration and impact of their disruption, and the insured's mitigation strategies. The underwriter should then assess whether the existing policy, or an endorsement, adequately addresses this contingent business interruption risk. This aligns with the regulatory expectation, as per the CII's focus on commercial insurance principles and good practice, that insurers should underwrite risks responsibly, ensuring that policy terms accurately reflect the risks being covered and that policyholders are adequately protected for the premiums paid. It also reflects the ethical duty to act with due skill, care, and diligence, and to treat customers fairly by not exposing them to unmanaged or unpriced risks. An incorrect approach would be to dismiss the supplier dependency as irrelevant because the insured's property itself is not physically damaged. This fails to acknowledge the interconnectedness of modern supply chains and the potential for indirect losses. Ethically, this approach could lead to a significant underinsurance gap for the policyholder, leaving them exposed to substantial financial losses that they might reasonably expect to be covered. It also demonstrates a lack of due diligence in risk assessment. Another incorrect approach would be to automatically include broad contingent business interruption cover without a proper assessment of the specific supplier risk and its potential impact. This could lead to adverse selection and potentially unpriced risk for the insurer, which is not sustainable and could lead to future claims that are disproportionately high. While appearing to offer comprehensive cover, it fails to manage risk prudently and could result in future policy adjustments or increased premiums that negatively impact the policyholder. A third incorrect approach would be to simply apply a standard percentage uplift to the business interruption, sum insured without understanding the specific nature of the supplier dependency. This is a superficial assessment that does not account for the unique vulnerabilities of the insured's business and its supply chain. It risks either underinsuring the contingent risk or overinsuring it, leading to either inadequate protection or an unnecessarily high premium for the policyholder, both of which are professionally unsound. The professional decision-making process for similar situations should involve a structured risk assessment that moves beyond direct physical damage. This includes 1. Identifying critical dependencies, suppliers, customers, utilities. 2. Quantifying the potential impact of disruption to these dependencies, duration, financial loss. 3. Evaluating the insured's mitigation strategies. 4. Determining the appropriate insurance response, standard policy, endorsement, exclusion, or declining cover if the risk is unmanageable. 5. Clearly communicating the scope of cover and any limitations to the policyholder. Question 15. Assessment of how an insurance broker who has a personal investment in a company that supplies essential replacement equipment for businesses should manage their professional responsibilities when advising a commercial property owner on a business interruption insurance policy that covers such equipment replacement. Option A. Disclose the personal investment to the client and insurer, and recuse themselves from advising on the specific aspects of the business interruption policy related to equipment replacement. Option B. Advise the client to purchase replacement equipment from the invested company, highlighting the broker's familiarity with the supplier as a benefit. Option C. Advise the client on the business interruption policy without disclosing the personal investment, relying on professional integrity to ensure unbiased advice. Option D. Disclose the personal investment to the client and insurer, but continue to advise on the policy, allowing the client to weigh the information. The correct answer is A. Disclose the personal investment to the client and insurer, and recuse themselves from advising on the specific aspects of the business interruption policy related to equipment replacement. Explanation. This scenario presents a professional challenge due to the inherent conflict of interest arising from an insurance broker's dual role. The broker is tasked with advising a commercial property owner on a business interruption insurance policy, while simultaneously holding a significant personal investment in a company that supplies essential replacement equipment for businesses affected by property damage. This creates a situation where the broker's personal financial interests could potentially influence their professional judgment, leading to advice that may not be solely in the best interest of the client. Careful judgment is required to ensure that the client's needs and the regulatory obligations are paramount. The correct approach involves the broker proactively disclosing their personal investment to the client and the insurer, and then recusing themselves from advising on the specific aspects of the business interruption policy that relate to equipment replacement or any other area where their investment might create a conflict. This approach upholds the principles of transparency and client best interests, which are fundamental to regulatory frameworks governing insurance intermediaries. Specifically, under the Financial Conduct Authority (FCA) Handbook, particularly in relation to conduct of business rules, COBs, and principles for businesses, PRIN. Firms and individuals must act honestly, fairly, and professionally in accordance with the best interests of their clients. Disclosure and recusal are key mechanisms for managing conflicts of interest and demonstrating adherence to these principles. An incorrect approach would be to proceed with advising the client without any disclosure, believing their professional integrity will prevent bias. This fails to meet the regulatory requirement for transparency and could lead to a breach of the duty to act in the client's best interests. The client is not made aware of a potential influence on the advice given, undermining trust and potentially leading to an inadequate policy being recommended. Another incorrect approach would be to disclose the conflict but continue to advise on the policy, arguing that the client can make their own judgment. While disclosure is a step, continuing to advise when a significant conflict exists, especially concerning a core element of the policy, is insufficient. The regulatory expectation is not just disclosure, but also effective management of the conflict, which may necessitate stepping away from the advice altogether to ensure the client's interests are not compromised. A further incorrect approach would be to advise the client to purchase equipment from the broker's invested company, framing it as a beneficial arrangement due to the broker's familiarity with the supplier. This is a direct manifestation of the conflict of interest, prioritizing the broker's personal gain over the client's objective assessment of the best supplier and terms. This would be a clear breach of regulatory obligations and ethical standards, potentially leading to significant client detriment and regulatory sanctions. The professional decision-making process for similar situations should involve a systematic identification of potential conflicts of interest. Once identified, the professional must assess the nature and significance of the conflict. The primary consideration should always be the client's best interests. If the conflict cannot be effectively managed through disclosure and mitigation, the professional should consider recusing themselves from the matter or seeking independent advice for the client. Transparency with all relevant parties, including the client and the insurer, is crucial throughout this process. Question 16. Upon reviewing a commercial property and business interruption claim following a fire that has temporarily closed a retail business, what is the most appropriate risk management strategy for the insurer to adopt regarding the insured's mitigation efforts? Option A. Deny any business interruption payout until the insured can provide absolute certainty that every conceivable step has been taken to mitigate losses, regardless of practicality. Option B. Proactively engage with the insured to understand their specific business interruption mitigation strategies and assess their adequacy in line with industry best practices and regulatory guidance on claims handling. Option C. Focus solely on the precise wording of the business interruption policy clauses related to mitigation, without considering the broader context of the insured's operational realities. Option D. Automatically assume the insured has implemented all possible mitigation measures to minimize their losses and proceed with the claim payout based on this assumption. The correct answer is B. Proactively engage with the insured to understand their specific business interruption mitigation strategies and assess their adequacy in line with industry best practices and regulatory guidance on claims handling. Explanation. This scenario is professionally challenging because it requires an insurer to balance the immediate need to provide a business interruption payout with the regulatory obligation to ensure that the insured has taken reasonable steps to mitigate their losses. The insurer must avoid making assumptions about the insured's actions and instead rely on evidence and established risk management principles. The correct approach involves the insurer actively engaging with the insured to understand their specific business interruption mitigation strategies and assessing their adequacy in line with industry best practices and regulatory guidance on claims handling. This demonstrates a commitment to fair treatment of customers and adherence to the principles of prudent risk management, which are implicitly or explicitly required by regulatory frameworks governing insurance claims. The insurer's role extends beyond simply processing a claim. It includes ensuring that the policyholder has acted responsibly to minimize the impact of the insured peril, a concept central to the indemnity principle and regulatory expectations for claims management. An incorrect approach of automatically assuming the insured has implemented all possible mitigation measures without verification is a failure of due diligence. This could lead to overpayment of claims, undermining the principles of indemnity and potentially breaching regulatory requirements related to claims handling and financial prudence. Another incorrect approach, that of denying any payout until absolute certainty of maximum mitigation is achieved, is overly punitive and fails to acknowledge the practical realities of business operations during a crisis. This could be seen as a failure to act with reasonable speed and fairness, potentially contravening regulatory expectations for prompt and equitable claims settlement. A further incorrect approach, focusing solely on the policy wording without considering the broader context of risk management and mitigation, risks a narrow interpretation that may not align with the spirit of the insurance contract or regulatory expectations for a holistic claims assessment. Professionals should approach such situations by adopting a structured claims management process that includes understanding the policy terms and conditions, gathering evidence of the loss and the insured's mitigation efforts, consulting relevant industry guidance and regulatory expectations, and communicating transparently with the insured throughout the process. This ensures a fair and compliant outcome. Question 17. Compliance review shows that an underwriter has assessed a commercial property business interruption claim by focusing solely on the immediate physical damage to the insured premises, without fully considering the policy's definition of the period of interruption, or the potential for consequential losses arising from the disruption to the business operations. Which of the following approaches best aligns with the legal and regulatory environment governing commercial property and business interruption insurance in the UK? Option A. Proceed with a settlement offer based on the estimated cost of repairing the physical damage, assuming the business interruption period is directly and solely tied to the repair timeline. Option B. Immediately seek clarification from the policyholder regarding the full extent of business disruption and the specific clauses in the policy that define the period of interruption and period of restoration, and engage loss adjusters to assess the financial impact on the business operations. Option C. Inform the policyholder that the claim assessment is complete and that any further information required would necessitate additional fees from the policyholder. Option D. Deny coverage for business interruption losses, arguing that the policy only covers direct physical damage and not the indirect impact on business operations. The correct answer is B. Immediately seek clarification from the policyholder regarding the full extent of business disruption and the specific clauses in the policy that define the period of interruption and period of restoration, and engage loss adjusters to assess the financial impact on the business operations. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the insurer's need for accurate risk assessment with the policyholder's right to clear and understandable policy terms, all within the strict confines of the UK regulatory framework for commercial insurance. The Financial Conduct Authority (FCA) Handbook, particularly the Insurance Conduct of Business ICOB's Sourcebook, mandates clear communication and fair treatment of customers. Misinterpreting or misapplying policy wording can lead to significant financial and reputational damage for the insurer and potential detriment to the policyholder. The correct approach involves a thorough review of the policy wording in conjunction with the specific circumstances of the business interruption claim. This requires understanding the definitions of period of interruption, damage, and period of restoration as defined within the policy and as interpreted by relevant UK case law and regulatory guidance. The FCA's principles for businesses, especially Principle 6, Customers' Interests, and Principle 7, Communications with Clients, are paramount. By seeking clarification from the policyholder and potentially engaging loss adjusters or legal counsel, the underwriter demonstrates a commitment to a fair and accurate assessment, adhering to the spirit and letter of ICOB's 8, Business Interruption Insurance, and the FCA's overarching duty of care. This proactive and diligent approach ensures that the claim is handled in a manner that is both compliant with regulatory requirements and ethically sound, safeguarding the interests of all parties. An incorrect approach that focuses solely on the initial assessment of physical damage without considering the policy's definition of the period of interruption fails to acknowledge the complexity of business interruption claims. This overlooks the regulatory expectation that insurers will not impose undue burdens on policyholders and will interpret policy terms reasonably. Such an approach risks contravening ICOB's 8.3.1r, which requires insurers to treat claims fairly and promptly. Another incorrect approach that involves immediately denying coverage based on a narrow interpretation of damage, without exploring the policy's intent or relevant case law, is also professionally unacceptable. This demonstrates a lack of due diligence and a failure to act in the customer's interests, potentially breaching FCA Principles 6 and 7. It also ignores the FCA's guidance on handling business interruption claims, which emphasizes a customer-centric approach. A third incorrect approach that involves making a settlement offer without fully understanding the extent of the business interruption and the policy's coverage for consequential losses would be equally problematic. This could lead to an underpayment of a valid claim, causing financial hardship to the policyholder and potentially resulting in regulatory sanctions for the insurer. It fails to uphold the insurer's obligation to provide clear and accurate information and to settle claims in accordance with the policy terms and regulatory expectations. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understanding the policy wording and its definitions. Second, gathering all relevant facts and evidence from the policyholder and other sources. Third, consulting with internal experts, e.g., claims handlers, legal department, and external specialists, e.g., loss adjusters as needed. Fourth, considering relevant regulatory guidance and case law. And finally, making a decision that is fair, compliant, and in the best interests of both the policyholder and the insurer. Question 18. Performance analysis shows that a commercial property insurer is reviewing the security system recommendations for a client operating a high-value retail jewelry store in a city center location. The insurer has identified that the current security measures are minimal. The insurer is considering recommending an upgrade to the client's security system. Which of the following approaches best reflects the insurer's professional and regulatory obligations in this situation? Option A. Recommend a comprehensive multi-layered security system that includes advanced CCTV surveillance, reinforced display cases, a monitored alarm system with dual communication paths, and access control for staff, explaining how each component addresses specific identified risks of theft and burglary. Option B. Advise the client to research and select their own security system, as the insurer is not responsible for specifying technical security solutions. Option C. Suggest the client install the most basic, cost-effective alarm system available on the market, as this will satisfy a minimum requirement and reduce the immediate cost for the insured. Option D. Recommend a highly sophisticated, state-of-the-art biometric access control system for all entry points, as this represents the pinnacle of security technology. The correct answer is A. Recommend a comprehensive, multi-layered security system that includes advanced CCTV surveillance, reinforced display cases, a monitored alarm system with dual communication paths, and access control for staff, explaining how each component addresses specific identified risks of theft and burglary. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need to manage risk and control costs with the insured's legitimate expectation of adequate protection and fair treatment. The insurer must act with due diligence and skill, ensuring that recommendations for security systems are not only cost-effective, but also genuinely enhance the insured's security and reduce the likelihood of claim, thereby aligning with the principles of good faith and fair dealing inherent in insurance contracts. The insurer's advice directly impacts the insured's operational resilience and financial exposure. The correct approach involves a thorough, risk-based assessment of the insured's specific business operations, location, and the nature of the property being insured. This assessment should identify vulnerabilities and then recommend security systems that are proportionate to the identified risks and meet relevant industry standards or best practices. The insurer should provide clear, actionable advice, explaining the rationale behind the recommendations and the potential benefits in terms of risk reduction and, where applicable, premium adjustments. This aligns with the regulatory expectation that insurers act with integrity and provide advice that is in the best interests of the policyholder, considering the overall risk profile. An incorrect approach would be to recommend a generic, one-size-fits-all security system without a proper assessment of the insured's unique circumstances. This fails to demonstrate due diligence and could lead to the insured investing in a system that is either inadequate for their specific risks or unnecessarily expensive. Ethically, this could be seen as a failure to act in good faith, as the advice is not tailored to the insured's actual needs. Another incorrect approach would be to solely focus on the cheapest available security system, regardless of its effectiveness or suitability. This prioritizes cost saving over adequate risk mitigation, potentially leaving the insured vulnerable to losses that could have been prevented. This approach breaches the duty of care owed to the policyholder and may contravene regulatory requirements regarding the provision of advice and the assessment of risk. A further incorrect approach would be to recommend a system that is overly complex or technologically advanced for the insured's operational capacity to manage and maintain. This could lead to system failure due to user error or lack of proper upkeep, rendering the security measures ineffective. This demonstrates a lack of understanding of the insured's business and a failure to provide practical, sustainable advice. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the insured's business and risk profile. This involves active listening, asking pertinent questions, and conducting site visits where appropriate. Recommendations should then be developed based on this understanding, considering a range of suitable security options and their respective benefits and drawbacks. Transparency regarding the rationale for recommendations and potential implications for the insured is crucial. Professionals must always prioritize the insured's best interests, ensuring that advice is practical, effective, and compliant with all relevant regulatory and ethical standards. Question 19. Implementation of a new business interruption insurance policy for a technology firm with significant intellectual property and customer data raises concerns about potential cyber-related losses. Which of the following underwriting approaches best aligns with regulatory expectations and professional best practice for assessing and pricing this risk? Option A. Impose a comprehensive list of advanced cybersecurity certifications and technologies as a mandatory prerequisite for coverage, regardless of the firm's operational scale. Option B. Conduct a detailed assessment of the firm's cybersecurity controls, incident response capabilities, and data protection measures, and use this information to tailor policy terms and pricing, while also providing guidance on best practices. Option C. Offer a broad business interruption policy that explicitly excludes all losses arising from cyber incidents without detailed discussion or explanation of the exclusion scope. Option D. Rely solely on the firm's self-declaration of having standard cybersecurity measures in place and proceed with standard business interruption policy terms. The correct answer is B. Conduct a detailed assessment of the firm's cybersecurity controls, incident response capabilities, and data protection measures, and use this information to tailor policy terms and pricing, while also providing guidance on best practices. Explanation. This scenario is professionally challenging because it requires an insurance underwriter to balance the immediate need to secure business interruption coverage with the evolving and complex risks associated with cybersecurity. The underwriter must not only assess the likelihood and impact of a cyber event, but also ensure that the proposed policy terms adequately reflect the insurer's risk appetite and the insured's mitigation efforts, all within the regulatory framework governing insurance contracts. The correct approach involves a thorough and documented assessment of the insured's cybersecurity posture, including their existing controls, incident response plans, and data protection measures. This assessment should inform the underwriting decision, leading to policy terms that are appropriate for the identified risks. This aligns with the principles of prudent underwriting and the regulatory expectation that insurers understand the risks they are insuring. Specifically, under the FCA's principles for businesses, particularly Principle 3, Customers' Interests, and Principle 6, Communicating Information to Customers, and the ICO's guidance on data protection. Insurers have a responsibility to ensure policies are fair, transparent, and reflect the actual risks. A proactive engagement with the insured on cybersecurity best practices, even if not a direct contractual requirement, demonstrates a commitment to responsible risk management and customer welfare. An incorrect approach would be to simply accept the insured's self-assessment without independent verification or further inquiry. This fails to meet the underwriter's duty of care and could lead to underpricing the risk, potentially resulting in financial losses for the insurer and inadequate coverage for the insured. It also risks breaching regulatory requirements related to risk assessment and due diligence. Another incorrect approach is to impose overly stringent cybersecurity requirements that are not commercially viable or proportionate to the insured's business size and type. While robust security is desirable, an unworkable policy can lead to disputes and reputational damage. This could contravene the spirit of fair dealing and potentially lead to the insurer being seen as acting in bad faith. Finally, an incorrect approach is to exclude all cyber-related business interruption losses without clearly communicating this exclusion and its implications to the insured. This lack of transparency and potential for the insured to be unaware of significant coverage gaps is a failure of communication and could lead to significant customer detriment, a direct contravention of regulatory expectations. Professionals should adopt a risk-based approach, conducting due diligence commensurate with the complexity and potential impact of the risk. This involves understanding the insured's business, their specific cyber exposures, and the effectiveness of their mitigation strategies. Clear communication with the insured regarding policy terms, conditions, and any specific cybersecurity expectations or exclusions is paramount. Regular review of cyber risk trends and their impact on underwriting practices is also essential for maintaining competence and ensuring compliance. Question 20. Which approach would be most appropriate for an insurance claims handler when analyzing a business interruption claim arising from material damage to ensure compliance with the Commercial Property and Business Interruption Exam (CI) regulatory framework and best practice? Option A. A comprehensive review of the policy wording, considering the specific cause and extent of the material damage and its direct impact on the insured's business operations, in line with regulatory expectations for fair claims handling. Option B. A reliance on historical claims data and previous settlement figures for similar incidents, without a detailed re-examination of the current policy wording and loss circumstances. Option C. A focus on identifying any policy exclusions that might limit the insurer's liability, interpreting ambiguous clauses in favor of the insurer to manage potential financial exposure. Option D. An initial assessment based on the most obvious and visible signs of damage, with a view to providing a preliminary estimate of the claim value to expedite the process. The correct answer is A. A comprehensive review of the policy wording, considering the specific cause and extent of the material damage and its direct impact on the insured's business operations, in line with regulatory expectations for fair claims handling. Explanation. This scenario is professionally challenging because it requires a nuanced interpretation of policy wording in the context of a business interruption claim, where the precise cause of damage and its impact on operations must be meticulously assessed. The insurer's duty of utmost good faith in the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, are paramount. A failure to accurately interpret the policy wording can lead to underpayment or denial of a legitimate claim, causing significant financial hardship to the policyholder and potentially breaching regulatory obligations. The correct approach involves a thorough and objective analysis of the policy wording, considering the specific circumstances of the loss and relevant case law or guidance issued by the FCA or industry bodies like the Chartered Insurance Institute (CII) itself, which often provides guidance on best practice for its qualifications. This approach prioritizes a fair and accurate assessment of the claim based on the contractual terms and regulatory expectations. It ensures that the policyholder receives the indemnity they are entitled to under the policy, upholding the insurer's duty of good faith and regulatory compliance. An incorrect approach that focuses solely on the immediate, visible damage without considering the policy's definition of damage, or interruption, would be professionally unacceptable. This could lead to a misinterpretation of the policy's scope, potentially excluding coverage for consequential losses that are, in fact, covered. Such an approach risks breaching FCA Principle 6 by not acting in the customer's best interests. Another incorrect approach that prioritizes a quick settlement over a comprehensive review of the policy wording and the loss circumstances would also be professionally unsound. This might be driven by internal efficiency targets, but fails to meet the regulatory requirement for fair treatment of customers. It could lead to an inaccurate assessment of the claim's validity and quantum, potentially resulting in a breach of FCA Principle 7 by not communicating clearly and fairly with the client about the basis of the settlement. Finally, an approach that relies on outdated interpretations of policy wordings without considering recent regulatory guidance or industry best practices would be a failure. The regulatory landscape and interpretation of insurance contracts evolve, and professionals are expected to stay abreast of these changes to ensure their advice and actions remain compliant and ethically sound. This could lead to a breach of the FCA's Principle 3, managing efficiently and soundly, by not maintaining adequate knowledge and competence. The professional decision-making process for similar situations should involve 1. A complete understanding of the policy terms and conditions, including definitions and exclusions. 2. A thorough investigation of the factual circumstances of the loss. 3. Consideration of any relevant regulatory guidance, industry standards, and legal precedents. 4. Objective assessment of how the facts align with the policy wording and regulatory requirements. 5. Clear and transparent communication with the policyholder throughout the claims process.